Hello, everyone, and welcome to the Injective Global Virtual Hackathon. Today's presentation will be on an intro to DeFi on Injective. So first, let's start with an overview of Injective's decentralized exchange. There are many different kinds of markets tradable on Injective, which include spot markets, perpetual markets, expiry futures markets, and binary options markets. And yeah, this is all on Injective's decentralized on-chain limit order book. So first, I'll start with conceptually the differences between an order book and an AMM, or an automated market maker. On an order book on the left, you can see that there are discrete individual limit orders that are actually created by anyone on the market. So it's peer-to-peer. People place their orders, other people can fill them, and that's the way trading can occur. And of course, people can decide what price and what quantity they choose to place their orders at. On an AMM, you are trading against the pool, where people can deposit their funds into a smart contract typically, and the market making will be in accordance with a formula. In this case, X times Y equals K, or a constant product market making formula. And basically, the price that you get is dependent on the quantity of each of these tokens in the pool, where X is the quantity of token A, Y is the quantity of token B, and this product has to always equal a constant. Yeah. So, what are the benefits of an order book, particularly Injective's order book? The biggest benefit truly is capital efficiency for one. One of the main drawbacks of an AMM is that the majority of the liquidity, the funds are practically never used because of how capital inefficient or how poor slippage one gets when trying to place trades that push you up that curve. And another benefit, of course, is no impermanent loss. As an LP, on AMMs, you may commonly face impermanent loss, and it's actually one of the main drawbacks of AMMs that LPs typically lose money. On an order book, you can fully control the price at which you want to sell or buy, and you don't have this problem. This also leads to less slippage and more efficient price discovery. On an Injective in particular, you also have lower trading fees, and oftentimes on the maker side, you even get a rebate, so you get paid to trade. Whereas in an AMM, you have quite high fees, typically on the order of 0.3% or so, to compensate for the liquidity that these AMM LPs are providing. On Injective, we also have front-running resistance, and that's achieved through Injective's frequent batch auctions, where instead of orders being matched in a first in, first out or FIFO style, we use FBA with a uniform clearing price, so that all orders that come in on a given block get cleared with the same price uniformly. So some concepts about limit order books in general first. Of course, there are limit orders in a limit order book. And for spots, when you create a limit order, it specifies the intent to buy or sell a given token at a given price or better. So, creating an order to buy one Bitcoin at $28,000 as an example. In a derivatives order book, it specifies the intent to enter into a long or short position at a given price or better. For derivatives, of course, you aren't actually trading the actual asset. That's why it's a derivative instrument. And instead you enter into a position. And the price at which you enter in that position, you can specify, and of course the quantity as well. There are also market orders, which in the spot case, it specifies the intent to buy or sell a token at any price. And actually on Injective, there's an asterisk there. But first for derivatives, it's also the same. The the intent to enter into a long or short position at any price, with the caveat that on Injective, the market orders specify actually a worse price, more of a built-in slippage protection mechanism. Yeah, of course, trading has encouraged trading fees, which are charged based off the volume of the trade. And yeah, different fees exist for maker and versus taker volume. As I mentioned before, most markets on Injective have a negative maker fee and a positive taker fee. So if the maker fee is negative 0.1% or 1 basis point, that means for every $10,000 of volume you contribute, you actually get back $1 as a rebate. And of course, for a taker fee, let's say it's 0.1% or 10 basis points. For every $10,000 of volume, you would pay $10 in fees. And yeah, just one note here is that while these fee amounts may seem, not that small, not that big, it can actually have a very big influence on profitability, especially in the long term. So getting paid to trade actually through these rebates with negative maker fees can make a very big difference. All right. Now I'll go over some of the topics regarding spot exchange. So generally, in spot trading, you swap one token for another, and on Injective, the actions relevant for spot trading, when you send a transaction, for example, are creating limit orders and market orders, canceling limit orders, and yeah, actually that's it. So that's essentially what you need to know. Of course, you still have to get the funds on Injective and such, but yeah, these are all relevant concepts. For derivatives, there are, first of all, 3 kinds of derivative instruments supported on Injective. These include perpetual swaps, expiry futures, and binary options. And the relevant actions for derivatives trading are, of course, like before, creating limit orders and also market orders. And what this does is, upon getting filled, this creates a long or short derivative position. Or if you already had one and your order is in the opposite direction, it can also close your position as well. Of course, you can also cancel your limit orders. And once you have a position, you can also choose to add margin to it. Yeah, and on Injective, it's possible to create and cancel multiple orders in multiple markets in one message, which is called message batch update orders. So let's dive into perps. So perpetual swaps, or commonly called perps, they are an instrument that enables traders to get perpetual synthetic exposure to some underlying asset. So for example, the BTC to USDT perp, you can use that to get long or short exposure to Bitcoin using USDT as collateral. And most importantly, they allow for leverage trading. So here, traders will supply margin in the form of the quote asset, which in this case is USDT, to enter into a position which will give you levered exposure to some underlying asset, which in this case is Bitcoin. So as an example, you can pay $100 or USDT to go long a notional value of $1,000 worth of Bitcoin, and this would be 10x leverage. So leverage, of course, enhances your buying power, which will magnify your gains when you're right, but also magnify your losses when you're wrong. So if Bitcoin, in this example, goes up 5%, you'll make $50. But if Bitcoin goes down 5%, you'll lose $50 and possibly also risk liquidation if it goes down more. So unlike futures, perps never expire, but instead use what's called a funding rate to keep the price of the perpetual in line with the underlying. How this works is when the price of the perp is higher than the underlying, then all the long positions will pay the short positions. In this case, then the funding rate will be positive. Conversely, when the price of the perp is lower than the underlying, shorts will pay longs. And yeah, funding rates are calculated every hour based off the difference of the perp versus the actual index price of the underlying. Understanding expiry futures. So similar to perpetuals, futures enable traders to get leveraged synthetic exposure to some underlying asset, but not forever, only up to a certain date when the future expires. That's why they're called expiry futures. As an example, BTC USDT 30 June 23 is a futures market that expires on June 30th. Oh, yeah, June 30th, 2023. Upon expiration, all open positions are settled. So on June 30th, your positions will be closed with a 30-minute time-weighted average price prior to expiry. So, yep. And unlike perps, futures have no funding rate. Instead, at settlement, at the expiration, this 30-minute TWAP calculation, which is used for the closing price, is a natural forcing function to keep the price of the future in line with the underlying. So of course, this means that, let's say, if you entered into your position at, let's say Bitcoin was at, well let's say you entered it earlier at, let's say, $25,000, and at June 30th, if the price of Bitcoin then is $40,000, then you would get paid out based off that price, right? So you would make some money if you were long, you would lose money if you were short. However, the futures price can diverge from the underlying, and this typically expresses the sentiment of the market. So when futures are greater than the underlying price, then this is referred to as contango, which is a bullish, typically a sign of a bullish market. And conversely, when the futures price is lower than the underlying price, you can have backwardation, or which typically reflects more bearish sentiment. But eventually, the closer you get to the actual date of the expiration, well, upon the expiration, the prices should converge. Otherwise, there's actually free money on the table. You know. All right. Next, I'll go over binary options. So unlike perpetuals or futures, binary options have a binary payoff, which means a 0 or 1 payoff. And a major use case for this is prediction markets. An example is like if you wanted to speculate on, let's say, will Argentina win the next World Cup, or will the price of Bitcoin go over $30,000 in 2023? You can enter into a position, basically yes or no. And if Argentina does win, then you'll get paid out $1 per contract. If they don't win, you'll lose the money that you put in, etc. So yeah, just to give you a more concrete example, I guess you can buy 100 contracts at 20 cents per contract. That will pay out $1 if Argentina wins. So if they do win, you'll win $80. If Argentina loses, you'll have lost the money that you have put in, which in this case is $20. So here, your order is matched against another trader who pays 80 cents per contract to take the opposing view. So in this case, if Argentina wins, that trader loses $80. If Argentina loses, that trader wins $20. And so yeah, as you can see, it's a zero-sum system. Some benefits of binary options on an order book, on Injective in particular, is that traders can close their positions or take profits at any time, instead of having to wait until the outcome occurs to realize their profits. And yeah, the benefits of this also include capital efficiency and better spreads. There's no more like paying the house or having the house be the sole market maker, which is like a major difference compared to many traditional sports betting platforms. As I mentioned, Injective matches orders using what's called a frequent batch auction. And here, the orders are matched at the end of each block with a uniform clearing price. And the main reason for this is to prevent front running. I can go into the actual high-level design of the matching engine. First, market orders are matched against resting limit orders. So in this case, resting means that they've already been added to the order book officially. Yeah, they're resting. Then the new orders that arrived at that block, which are not resting, by the way, are matched against the other resting limit orders. And yeah, the way matching occurs is if a buy and a sell order or a set of them have a negative spread, meaning that they cross each other, then they will get matched. And these two sets of orders will be matched such that the maximum set of orders can be filled, given that they have a negative spread at a uniform clearing price. So an important implication is that like smart contracts seeking to execute logic, depending on whether their orders are filled or not, can handle or determine this by tracking balance and positions upon a trade. Or there's actually a workaround around FBA, which allows you to execute a market order atomically, but you pay 2x the fees in order to do so. All right. So Injective is an open permissionless system. You can also create your own markets if you choose to. So there's two paths to launching your own market. One is an instant launch in which a listing fee is required. And this is only supported for spot and binary options markets. You can also launch markets through governance approval, where you can create a proposal to launch or modify different parameters of a market. And this gives you more flexibility to specify certain parameters that you wish to. For instant launches, not all of these parameters are actually setable by you. Instead, some defaults are used. So I'll do a breakdown of what goes into an actual spot market. So first of all, you specify the ticker symbol, which is in this case, let's say INJ/USDT. You also specify the token that you want to trade, or the denom of the base asset. In this case, the base asset is INJ, as well as the quote denom as well. In this case, it's USDT. And yeah, one caveat is that you need to actually specify the actual like denom name on Injective, which in this case, so this is the 0xDAC part here is actually the address of USDT on Ethereum. On Injective, it's represented as PEGI plus the 0xDAC. There are also tick sizes that are relevant, which specify the minimum price and quantity increment for each order. And yeah, so the important thing to note here is that for spot markets, the price reflects the relative exchange rate between two tokens. And each token has its own decimal representation. So yeah, INJ, for example, has 18 decimals. So like one INJ, like in the human readable form, actually is expressed by 1E18 INJ, because INJ has 18 decimals. Conversely, 1 USDT is 1 million PEGI 0xDAC, etc., because the USDT has 6 decimal places. So therefore, for an INJ USDT price of 3.5, the price on chain is represented as 3.5 times 10 to the 6 minus 18, or 3.5 times 10 to the negative 12, which may be a little bit confusing. But yeah, because you're actually exchanging INJ for USDT, and you're doing so in these raw quantities, the prices actually are reflected in this manner. So yeah, therefore, going back to tick sizes, if you want to have users trade in price increments of, let's say, 0.001, the min price tick size should be 1E negative 15, right? Since he already had this like 1E negative 12. And if you want to have 3 more decimal places, then it would be, yeah, this 1 times 10 to negative 12 times 1 times 10 to negative 3, which gives you 1e negative 15. And if you want to instead have users trading quantity increments of 0.001, here, because the quantity is an INJ, which has 18 decimals, similar thing, 1e18 times 1e negative 3 equals 1e15. There are also trading fees, which can be specified in the market. As I mentioned before, yeah, you can specify your maker fee and taker fee rate. And of course, maker fees can also be negative. You also have a relayer fee share rate. So on Injective, those who source liquidity are rewarded with a portion of the trading fee defined by the relayer fee share rate. So typically on Injective, this is 40%, which means that if a user pays $10 in fees, $4 would go to the sourcer of that liquidity, which can be, let's say, a front end or some other address. And the remaining percentage goes to the actual protocol. Yeah, and it's set to 40% as a default. You can see the existing markets at this link here, just to see the actual raw representation of the spot markets. Perp markets. So there are a few prerequisites to launching a perp market. First, an Oracle price feed for the market must exist. And also an insurance fund for the market has to exist. The insurance funds are used in the event that a liquidation requires more capital to cover the positions, I guess, equity that's not present. Yeah. Also, of course, the quote denom used for the market must exist on Injective. So breaking down the parts of a perp market, you first, of course, have to have the ticker, same as before, the quote denom, and also the min price and quantity tick sizes. The difference here is that because we are trading a synthetic instrument and not an actual token itself, it's a little bit more straightforward. As an example, for an INGC perp of 3.5 price, the price on chain is represented in this form. So the actual amount of USDT, in this case, 3.5 E6, because of course USDT has 6 decimal places. So therefore, if you seek to have users trade in price increments of 0.001, the min price tick size should be 1,000. And if you want the same for quantity increments, actually, because now you're trading some synthetic asset, your min quantity size can actually just be the human readable form. Yeah. They also have Oracle data that markets must specify, which in this case include Oracle base, Oracle quote, and Oracle type. So currently on mainnet, we use INJ for the Oracle base, USDT for Oracle quote, and band IBC for the Oracle type. We also have an Oracle scaling factor, which is a power of 10 scaling factor to apply to Oracle prices, mainly so that we can have the correct interpretation of the price based off the decimals of USDT, right? So in this case, it's 6 for USDT. Yeah, an important concept also is the initial margin ratios and maintenance margin ratios that the market must satisfy, as well as the maintenance margin ratio, which is the ongoing margin ratio that a position must satisfy before it gets liquidated. So here, if you want to have a max of, let's say, 10x leverage initially, your initial margin ratio would be 0.1. And you then, so in this case, then the maximum leverage that a user can have when they open a position would be 10x, since 1 divided by 0.1 equals 10. And then the question of when will a user get liquidated is determined by the maintenance margin ratio. So if you wanted to have, let's say, the user get liquidated when he had less than, let's say, or at a max of 50x leverage, then you could set a maintenance margin ratio of 0.02. So then, when let's say the trade went against him, he is losing money. Once his position becomes more than 50x levered, then he'll become liquidated. Yeah. So you can see this link to see all of the derivative markets on Injective currently, as well as the docs about the exchange for a deeper dive. All right. I can also walk through the actual messages needed to create markets. So for spot markets, you can create a message instant spot market launch, also a proposal to launch the market, and a proposal to update the market. There are also similar analogs for the derivative markets. So launching a proposal, a market, launching an expiry futures market, also binary options market, as well as updating the parameters for these markets. And of course, yeah, you can also instantly launch a binary options market. And of course, update the parameters of such market. All right, now that we've gone through these concepts, I'll speak a little bit more about how you can build DeFi applications on Injective. So first, you can create products that directly interact with Injective. So these can be, DEXs or other custom interfaces. It can also be some analytics service or dashboard, or some aggregator, right? So in this case, like you would just interact directly with the Injective chain. Like we send, some of these messages that I sent you, creating, canceling orders, etc., or just displaying data related to these to the exchange or other modules as well. You can also create smart contract applications that compose with Injective. So these can be things like structured products, pooled strategy vaults, some asset management services like an ETF, etc., insurance products, and even credit products. And really, the sky's the limit here. In order to build smart contracts, you'll have to create smart contracts in COSM WASM, which is the framework used for building smart contracts on Injective. This presentation won't go over it, but we have upcoming presentations as well that you can watch to see how exactly you can do this. All right, that's all for today. Thanks for listening.